Hello and welcome to this book summary of A Random Walk Down Wall Street by Burton Malkiel. This classic investment book is a must-read for anyone interested in the stock market or investing. Malkiel argues that trying to beat the market by picking individual stocks or timing the market is a fool's errand. Instead, he advocates for a random walk approach, where investors should simply buy and hold a diversified portfolio of low-cost index funds. In this summary, we'll take a closer look at Malkiel's arguments and advice, and see how they can be applied to our own investment strategies. Whether you're a seasoned investor or just starting out, this book has something valuable to offer. So let's get started. Chapter 1. Firm Foundations and Castles in the Air. Malkiel begins by outlining the two approaches to stock analysis: fundamental analysis and technical analysis. Fundamental analysis involves analyzing a company's financial statements and other data to determine its true value, while technical analysis involves looking at charts and other market data to predict future price movements. Malkiel argues that both approaches have their flaws. Fundamental analysis is limited by the fact that it's impossible to know all the relevant information about a company, while technical analysis is based on the assumption that past price trends can predict future ones, which is often not the case. Instead, Malkiel advocates for a different approach: the random walk. This theory states that stock prices move randomly over time, and that trying to predict short-term price movements is futile. Instead, investors should focus on buying and holding a diversified portfolio of low-cost index funds. Malkiel also debunks the idea that the stock market is a zero-sum game, where one person's gain is another's loss. He argues that the stock market is actually a positive-sum game, where everyone can benefit from the long-term growth of the economy. Chapter 2. The Madness of Crowds. In this chapter, Malkiel looks at the concept of market bubbles and the irrational behavior of investors. He argues that bubbles are caused by investor herd mentality, where everyone starts buying a particular stock or asset class simply because everyone else is doing it. Malkiel cites several examples of market bubbles, including the Dutch tulip mania of the 17th century and the dot-com bubble of the late 1990s. In both cases, investors became convinced that a particular asset was worth far more than its actual value, leading to a market frenzy that ultimately ended in a crash. Malkiel also debunks the idea that individual investors can make money by timing the market. He argues that trying to predict short-term price movements is impossible, and that investors who try to do so end up losing money in the long run. Chapter 3. The Madness of Crowds in the Stock Market. In this chapter, Malkiel looks specifically at the stock market and how it's affected by investor behavior. He argues that stock prices are often driven by irrational factors, such as rumors and speculation, rather than by a company's actual financial performance. Malkiel cites several examples of stock market bubbles, including the South Sea bubble of the 18th century and the stock market crash of 1929. In both cases, investors became convinced that stock prices would continue to rise indefinitely, leading to a market frenzy that ultimately ended in a crash. Malkiel also debunks the idea that individual investors can make money by picking individual stocks. He argues that most active fund managers fail to beat the market over the long term, and that investors are better off buying and holding a diversified portfolio of low-cost index funds. Chapter 4. The Madness of Crowds. Chapter 4 delves into the concept of market bubbles and manias, and the dangers they pose to investors. Malkiel explains that bubbles and manias occur when the market becomes detached from the underlying fundamentals of the securities being traded, leading to wildly inflated prices that are unsustainable. He cites examples such as the Dutch tulip mania of the 17th century, the South Sea bubble of the 18th century, and the dot-com bubble of the late 1990s. Malkiel warns investors to be wary of market manias and bubbles, as they can lead to irrational exuberance and cause investors to make poor investment decisions. He also emphasizes the importance of diversification and asset allocation, as a diversified portfolio can help mitigate the risks of market bubbles and manias. Chapter 5. The Madness of Crowds in the Stock Market Building. On the concept of market bubbles and manias, Chapter 5 explores the history of stock market bubbles and the irrational exuberance that often accompanies them. Malkiel discusses the 1920s stock market boom and subsequent crash, the Nifty 50 stocks of the 1970s, and the dot-com bubble of the late 1990s. Malkiel also examines the psychological factors that contribute to market bubbles, such as herd behavior and confirmation bias. He notes that investors often become caught up in the hype surrounding a particular stock or market sector, leading to a feedback loop of rising prices and increasing investor enthusiasm. Malkiel emphasizes that investors should remain rational and not get caught up in market manias, as they often lead to unsustainable price levels and eventual market crashes. He also stresses the importance of a long-term investment strategy and disciplined asset allocation, as these strategies can help investors weather market volatility and avoid costly mistakes. Chapter 6. Technical and Fundamental Analysis. Chapter 6 explores the two primary approaches to stock analysis: technical analysis and fundamental analysis. Malkiel explains that technical analysis involves the use of charts and other market data to predict future price movements, while fundamental analysis involves analyzing a company's financial statements and other metrics to determine its underlying value. Malkiel argues that both approaches have their limitations and are subject to biases and errors. He notes that technical analysis has been shown to be largely ineffective in predicting future stock prices, while fundamental analysis can be prone to over-optimistic valuations and subjective interpretation. Malkiel recommends that investors adopt a balanced approach to stock analysis, using both technical and fundamental analysis in conjunction with a long-term investment strategy and disciplined asset allocation. He also emphasizes the importance of keeping investment costs low, as high fees and expenses can erode returns over time. Chapter 7. Technical Analysis and the Random Walk Theory. In Chapter 7, Malkiel takes a closer look at technical analysis and its relationship to the random walk theory. He notes that technical analysts often rely on past price movements and chart patterns to predict future price movements, while the random walk theory suggests that stock prices are essentially random and unpredictable. Malkiel argues that technical analysis is largely ineffective in predicting future stock prices, as past price movements are not necessarily indicative of future performance. He cites numerous studies that have found little or no evidence of market inefficiencies that could be exploited through technical analysis. Malkiel recommends that investors avoid relying solely on technical analysis, and instead adopt a more balanced approach that includes both technical and fundamental analysis. He also emphasizes the importance of diversification and disciplined asset allocation, as these strategies can help mitigate the risks of market volatility and unpredictable price movements. Chapter 8. Technical and Fundamental Analysis. In Chapter 8, Burton Malkiel delves into the two main schools of thought when it comes to stock analysis: technical and fundamental analysis. Technical analysis involves using past price and volume data to predict future price movements, while fundamental analysis involves analyzing a company's financial statements and economic indicators to predict its future earnings potential. Malkiel argues that both technical and fundamental analysis are essentially useless in predicting future stock prices. He points out that the efficient market hypothesis suggests that all publicly available information is already reflected in a stock's current price, and that attempting to predict future movements based on past data is essentially a fool's errand. Malkiel provides several examples to illustrate his point, including the famous case of the Dow 36,000 inches prediction made in the late 1990s. This prediction was based on the idea that the stock market was significantly undervalued and that stock prices would soon skyrocket. Of course, this prediction turned out to be completely wrong, and the stock market went on to experience a major crash in the early 2000s. Malkiel also examines the concept of charting, which is a popular method of technical analysis. Charting involves looking for patterns in past price and volume data and using those patterns to predict future price movements. Malkiel argues that this approach is fundamentally flawed, as there is no evidence that past price movements are predictive of future movements. Chapter 9. A Fitness Plan for Your Portfolio. In this chapter, Malkiel discusses the importance of periodically rebalancing your portfolio to ensure that your asset allocation remains consistent with your investment goals and risk tolerance. He notes that rebalancing can be especially important after market movements or major life events such as a change in job or retirement. Malkiel then goes on to provide some guidance on how to rebalance a portfolio. He notes that the process should be straightforward and systematic, and should involve selling assets that have outperformed and buying assets that have underperformed. He also cautions against trying to time the market, as this is a difficult and often futile exercise. Malkiel then discusses the concept of dollar-cost averaging, which involves investing a fixed amount of money at regular intervals regardless of market conditions. He notes that this can be an effective way to build wealth over time, as it ensures that you are buying more shares when prices are low and fewer shares when prices are high. The chapter concludes with a discussion of tax-efficient investing strategies, including the use of tax-deferred retirement accounts and tax loss harvesting. Malkiel notes that these strategies can help to minimize the impact of taxes on investment returns, allowing investors to keep more of their hard-earned money. Chapter 10. A Life Cycle Guide to Investing. In this chapter, Malkiel provides some guidance on how to invest at different stages of life. He notes that younger investors with a long-time horizon can afford to take on more risk and should focus on building a diversified portfolio of equities. As investors approach retirement, however, they should gradually shift their portfolio towards fixed-income investments to reduce risk. Malkiel also notes that investors should consider their income needs and goals when investing. For example, investors who are saving for a down payment on a home in the near future may want to focus on more conservative investments with lower risk, while investors who are planning for retirement may want to take on more risk to achieve higher returns. The chapter concludes with a discussion of how to use annuities to provide a stream of income in retirement. Malkiel notes that annuities can be a valuable tool for investors who want to ensure a steady stream of income in retirement, but cautions against purchasing overly complex or expensive products. Chapter 11. The Investor and His Advisors, a Partnership in Need of Improvement. In the final chapter of the book, Malkiel discusses the role of financial advisors and the importance of finding a competent and trustworthy advisor. He notes that many advisors are motivated by their own self-interest rather than the interests of their clients, and that investors should be wary of advisors who charge high fees or recommend complex and expensive products. Malkiel also provides some guidance on how to find a good advisor, including checking credentials, references, and performance records. He notes that investors should also be clear about their own investment goals and risk tolerance, and should avoid advisors who are pushy or try to sell products aggressively. The chapter concludes with a discussion of the importance of maintaining a long-term perspective when investing, and the dangers of succumbing to short-term market fluctuations or fads. Malkiel notes that successful investing requires patience, discipline, and a willingness to stick to a well-conceived investment plan even when times are tough. In conclusion, A Random Walk Down Wall Street by Burton Malkiel is a must-read for anyone who wants to become a successful investor. The book presents a strong argument in favor of the efficient market hypothesis and demonstrates the superiority of a passive investment strategy over active management. Malkiel's writing style is engaging and accessible, making complex financial concepts understandable for readers of all backgrounds. He provides practical advice on how to construct a diversified investment portfolio and avoid common pitfalls, such as market timing and stock picking. While the book was first published in 1973, its insights remain relevant today, and it has been updated with new editions over the years. Malkiel's predictions regarding the future of the stock market have largely been accurate, which further reinforces the credibility of his arguments. Overall, A Random Walk Down Wall Street is a timeless classic that should be on the bookshelf of every serious investor. Malkiel's research and insights make a compelling case for a low-cost, passive investment strategy that can help investors achieve their financial goals over the long term. Thank you for following along with this summary of the book. We hope it has provided you with valuable insights into the world of investing and encouraged you to approach the market with a long-term perspective and a disciplined strategy.